Hey everyone, Bryan Marx here with Marx Mortgage Group. Today we're talking about a loan program that is a game changer for high net worth buyers. I'm talking about asset depletion. So here's the challenge. You might meet a client with a lot of money in investments, but their tax returns don't really show enough income in order to qualify for a traditional mortgage. Very common. So that stops a lot of deals cold. Now, asset depletion loans, they flip that script. Here's how it works. We're going to review 3 to 6 months worth of statements to document the eligible assets. We're talking checking accounts, savings accounts, stocks, retirement accounts, you name it. We're going to subtract what's needed for the down payment and the reserves. Then we divide what's left over by a set time frame. So if we're talking non-QM programs, we can do that by 84 months. We're talking a Freddie Mac loan, we can do that by 240 months. Or the full term of the mortgage for Fannie Mae. Now that monthly figure is treated as income to help them qualify. So key points to remember. Assets must belong solely to the borrower and usually can't come from business or gift funds. Now this is going to be for primary residence and second homes. Different accounts have different reductions. So retirement funds, for example, we're typically going to reduce by 20% to account for penalties or market changes. Now, there are also loan to value and property type restrictions. So depending on whether the loan is conventional or non-QM, this is going to change. For non-QM, figure you need to put down at least 15%. For conventional, it gets a little interesting. Fannie Mae, you have to put down 30% if you're under 62 years old or 20% down if you're over 62 years old. Now, Freddie doesn't have an LTV limit, but you have to be 62 years old to use retirement accounts. Now, a common question we get is, Bryan, can I use my crypto towards this? No, unfortunately, you can't use crypto towards this unless it's been converted into US dollars. So crypto itself, you can't utilize for this, but if you have crypto ETFs, we can actually use those. So who's the ideal client? We're talking retirees drawing minimal income, business owners who reinvest profits instead of taking a steady paycheck, maybe someone who recently sold a business, individuals with large cash or brokerage balances, and financially savvy clients who know it's not very smart to pay cash for a primary residence. Perfect example. Jay-Z is a billionaire, took out an $88 million mortgage last year. This is what we call smart money tax deductions. Now let's run some sample math scenarios. Your buyer has $1 million in assets left over in their accounts after down payment and closing costs. If this isn't a brokerage account and we go with a non-QM loan, we're going to take $1 million divided by 84 equals $11,904 per month in income that we can use. Now, if the money's in a retirement account, we're going to reduce that by 20%. So figure we can use $800,000 divided by 84 equals $95,223 per month in income. And if the $1 million in a brokerage account and we go Freddie Mac, that comes out to only $4,166 per month. So the key here is structuring, and that's why working with an expert like myself is really pivotal for these kind of loans. And bottom line, if your client has wealth but limited income on paper, this may be the key to getting them approved and into their next home. So if you have clients who might benefit from this and fit this profile, reach out to me. We can review their assets and build a plan tailored towards their specific goals. So let's not let paper income stop a deal when the money is sitting right there in their accounts. Like, share, and subscribe for more details.